Real estate has long been seen as the gold standard for building wealth. But is it still worth it in 2025? With rising interest rates, high property prices, and unpredictable markets, many are asking if rental income is still a smart move or a financial trap. The truth: real estate isn't dead, it's just changed. And if you understand the new rules of the game, it can still be one of the most powerful ways to generate passive income. In this video, we'll break down what's really happening in the market, how to spot profitable opportunities, and whether investing in rental property makes sense for your goals today. Let's get into it. Today we will talk about rental property income. Is real estate worth it in 2025? So before we get started, make sure to hit that like button. Also subscribe to my channel. Why real estate remains popular? Real estate remains a go-to for investors because it offers a unique combination of income and growth. Unlike stocks, you can use a mortgage to control a property far more valuable than your down payment. You pay off the mortgage while tenants cover your expenses. You receive monthly cash flow in addition to the property's long-term appreciation. And there are tax deductions, mortgage interest, depreciation, repairs, all reduce your taxable income. Even in 2025, these benefits stay strong, making rental properties attractive when done right. The challenges of today's market. On the flip side, 2025 has brought some real hurdles. Interest rates keep rising, making mortgages pricier. Home prices in many cities continue climbing, so rental yield, the ratio of rent to property value, is shrinking. Shrinking yields mean less cushion for investors. Add in stricter tenant laws, extra taxes on rental income or short-term stays, and rising insurance costs. And suddenly, real estate feels riskier. It's no longer a sure thing. You need more strategy, planning, and discipline. Cash flow versus appreciation today. Investors used to rely on appreciation, buying in a hot city and waiting for its value to skyrocket. Now, appreciation is still possible, but not guaranteed. Many smart investors in 2025 are shifting focus to consistent cash flow. That means finding properties where rent comfortably exceeds mortgage, taxes, insurance, and maintenance. Positive cash flow reduces risks when markets slow or rates rise. In the current climate, cash flow has become the foundation, while appreciation is a bonus. The sweet spot: emerging markets. The big opportunities in 2025 are with smaller, fast-growing cities and suburbs, places where population growth, jobs, and rental demand are rising, but home prices aren't yet inflated. You might not make millions overnight, but stable rental income and steady value gains are likely. These markets offer lower competition and better cash flow compared to big coastal cities. Do your research. Look for good schools, new businesses, improving infrastructure. That's where profits often hide. House hacking. One way in. Just starting out. House hacking still works. Buy a duplex, triplex, or even a single-family home with spare rooms. Live in one unit, rent out the others. Your tenants cover the mortgage. If you pick the right property, you could live rent-free while building equity. It's a powerful way to learn real estate skills, tenant management, repairs, local laws, without risking large sums of money. It's how many investors begin and scale from zero. Short-term versus long-term rentals. Another common choice is between long-term leases and short-term rentals like Airbnb. Short-term can pay better per night, but you also face seasonality, more work, cleaning fees, and tighter regulations. Some cities now cap Airbnb rentals or require licenses, insurance, and inspections. Long-term rentals are simpler and more stable. Tenants sign a year, rent is steady, and it's easier to forecast income. Many investors in 2025 prefer long-term rentals for the reliable, hands-free income. Common pitfalls to avoid. One of the most common mistakes is overlooking expenses. Repair work, vacancies, property taxes, HOA fees, and property management often erase your cash flow if you don't budget for them. Another mistake is emotion. falling in love with a property because of its curb appeal or location. Always think in numbers. If the rent doesn't exceed your costs plus margin, it's not an investment, it's a loan. Understanding financing in 2025. With mortgage rates higher than we've seen in years, financing demands more caution. Larger monthly payments mean you need stronger cash flow to make the numbers work. To improve deals, consider owner financing, seller carrybacks, HELOCs, or partnering with others. But leverage can be dangerous if misused. Always reserve some capital for emergencies and maintain a buffer of at least 3 to 6 months of expenses. Property management matters. Many new investors underestimate the workload. Tenant screening, rent collecting, small repairs, emergencies. Enter property managers. Yes, you pay typically 8 to 10% of monthly rent, but they handle everything from property marketing to tenant communication and maintenance. With higher rates and tighter cash flow, a good property manager can protect your investment and give you peace of mind. Worth it for most investors in 2025. Scaling up from one to many. Once you have one rental doing well, you can use equity and income to add more properties. Some use the BRRR strategy. Buy, rehab, rent, refinance, repeat to accelerate growth, but it requires renovation skills and risk tolerance. Others follow a buy and hold strategy in markets they trust. Scaling gives you diversification. One property may be slow, but 5 gives stability. Bigger portfolios also grant better mortgage terms and access to professionals. Tax and legal considerations. Taxes and regulations impact rental investors significantly. Some cities now tax earned stays or impose stricter eviction laws. Depreciation remains a valuable tax break, but consult a CPA to maximize it legally. LLCs and other legal structures can protect your personal assets, but come with setup costs. Regulatory changes come quickly. Keep informed on local laws to protect profitability and avoid surprises. Real-world numbers. To anchor this in reality, here's a simplified example. A $300,000 property in a growing suburb rents for $2,100/month. After factoring mortgage, taxes, insurance, vacancies, and repairs, you net around $200/month. That's nearly $2,400 per year. That return might not be flashy, but it's low risk and reliable. Add in eventual appreciation, and you're building wealth steadily. When it might not make sense, real estate isn't for everyone. If you need fast returns, prefer low risk, or can't tolerate handling tenants or emergencies, it might not be the right choice. In that case, dividend stocks or REITs might better suit your goals. Also, if you're buying in markets with low rental demand or poor tenant protections, you're taking unnecessary risk. How to get started? First, get clear on your goals. Do you want to build passive income, grow equity, or flip rentals for profit? Next, run realistic numbers. Don't guess. Use rent, expenses, financing to build a pro forma cash flow. Review deals with lenders or advisors. Visit properties in person and check the neighborhood and infrastructure. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.